What is up, guys, and welcome to lecture 1 of the TCT mentorship, where I'm going to be teaching you everything that you need to know about market structure. And it's absolutely key that you guys understand and master market structure because it's going to be the foundation of our trading going forward. We use market structure to confirm ranges, we use market structure to confirm future entry points, but most importantly, we use market structure to build context, which is absolutely key in this game of trading. Okay, so what exactly is market structure? Well, prices never go up or down in a straight vertical line. At any given moment in time, there will always be people buying and there will always be people selling. When prices are going up, that means that in the time window of going up, overall, there will be more buys than sells, but not in every exact moment. And those moments where more sells appear, that is what creates our market structure or the zigzag patterns that you see in the chart. So to visualize this text, let's look at Bitcoin's price action from October 2020 till April 2021. We can clearly see that in this time window of 3 to 4 months, prices went up, but not in every exact moment, because we can see in the highlighted areas right here that price was retracing. So in those exact moments, sellers had the overhand until buyers stepped in again, pushing price higher. But in this time window overall, there were more buys than sells, but not in every exact moment. And that is what creates those pivot points and those zigzag patterns, what we like to call market structure. Okay? And the exact same thing applies for when prices are going down. It means that in the time window of going down, overall, there will be more sells than buys coming in, but not in every exact moment. And those moments where more buys appear, that is what creates our market structure or the zigzag patterns that you see on the chart. So if we grab November 2021 all the way till November 2022, we can clearly see that overall in this time window, there were more sells than buys coming in because prices went down. But not in every exact moment, because in the highlighted areas right here, we can see price spike up. And that is what creates those pivot points, the zigzag patterns, which is what we call market structure. Okay? And it's absolutely crucial that not 100% of the time there are more sells or more buys coming in. Otherwise, prices would move vertically and we wouldn't have something to trade. Okay? So, always nice to know what exactly, the theory behind market structure is. Well, how do we apply and how do we draw valid market structure? In order to have valid market structure, we use something called the 6 candle rule. What is the 6 candle rule? In order to have valid market structure, we need a minimum of 2 consecutive bullish closing candles trading higher than each other, followed by a retracement of a minimum of 2 consecutive bearish closing candles trading lower than each other, followed by an expansion away of again a minimum of 2 consecutive bullish closing candles trading higher than each other. It's the 2-2-2 rule, aka the 6 candle rule. And when prices are going down, we need a minimum of 2 consecutive bearish closing candles, followed by a retracement up of a minimum of 2 consecutive bullish closing candles, each trading higher than each other, followed by an expansion away of yet again 2 consecutive bearish closing candles trading lower than each other. 2, 2, 2, in other words, the 6 candle rule. While applying the 6 candle rule, it's crucial that you understand that an inside bar candle does not count. What is an inside bar candle? An inside bar candle is when one of the two candles, its highs and its lows, are in between the highs and lows of the other candle. So right here we can see candle 2, and we can see that the high and the low of candle 2 is in between the high and low of candle 1, making candle 2 an inside bar candle. And when you have two bullish candles back to back, but one is an inside bar candle, or you have two bearish candles and one is an inside bar candle, it doesn't count in the 2-2-2 rule. And it doesn't have to be candle 2. It can also be candle 1, where the highs and lows of candle 1 are in between the highs and lows of candle 2. But it's crucial that you understand an inside bar candle doesn't count while drawing our market structure. Knowing how to draw a market structure now, it's also important to know when something becomes your market structure low or when something becomes your new market structure high. So when we're trending up and we're making higher lows and higher highs, a market structure low in an uptrend can only be confirmed the moment we touch our market structure high. So right here we have our market structure high, and the moment price touches the market structure high, right here, that is when your market structure low is confirmed. Okay? So what you do to identify your market structure low is you check when your market structure high is created, you wait until your market structure high gets touched again, and then you check what is the lowest point that price has traded in between the time of our high being created and our high being touched, and that is right here. And that becomes your market structure low. Okay? And then if we continue drawing and we have a new low and a new high, right here at this point in time, this is not your market structure low. This stays your market structure low until price touches the high again. So when price touches the high, that is when you use the same rule over again, where this is your market structure high, you wait for it to get touched again, you check what is the lowest point that price has traded in between my time, or in between the time of the high being created and the high being touched. That's right here. And now our new market structure low moves up. Okay? Now, when price is trending down, that means that our market structure high can only be confirmed the moment we touch our market structure low. So right here we have our market structure low, and this high is only confirmed the moment we touch our market structure low again. So what you do in a situation when we're trending down is you have your market structure low, you wait for that low to become touched again, and then you check what is the highest point that price has traded in between the time of my low being created and my low being touched. And that's right there. Okay? And that's how you identify your market structure high. Right here. Now, when price is retracing for a lower high, at this moment in time, this is not your new lower high, because your lower high can only be confirmed the moment we touch our market structure low. So the moment price touches that market structure low, that is when this high trails down and this becomes our new market structure high. And obviously, guys, these drawings with my path to are following the 6 candle rule. Okay, the 6 candle rule is always applied when drawing structure. So now we know how to draw our structure with the 6 candle rule, and we also know when to have a proper market structure low and a proper market structure high. Okay, so to make it all clear, let's apply it to the Bitcoin price action. And let's start from the Corona dump low and draw our market structure up. Okay, so grabbing our path to, right here we have our low. Okay, when do we meet the first requirement of 2 consecutive bullish closing candles trading higher than each other? And right here we can see candle 1 and candle 2. So the uptrend, the first expansion up, already meets the requirements. Now we just need to wait until we have a valid retracement. Right here, I only see one candle. I see one candle. Is this, for example, a valid retracement, guys, right here? No, this is not a valid retracement because in the retracement leg, there's only one bearish candle. It doesn't matter that afterwards you have multiple consecutive bearish closing candles because you need to have those candles while drawing structure in your retracement leg, not this internal price action. Okay, that doesn't count. So no, this is not a valid retracement. So then what do? Is we extend it until we do have a valid retracement. And right here, we can see that right at this point in time, okay, right at this point in time, we see one candle going down, two candles going down. So this retracement meets the requirement of the 6 candle rule. And then right here, we have the 2 expansion candles away again. So this whole move applies the 6 candle rule, okay? A minimum of 2 going up, a minimum of 2 going down, and a minimum of 2 going up again. And the moment, okay, the moment price touches this market structure high, so right here is your market structure high, and the moment it gets touched right here, that is when this becomes your market structure low. And while also drawing your structure, you see your market structure high, you see that the retracement follows the 2 candle rule, and then you wait for that high to get touched, and then you pick the lowest point as your market structure low. Okay, let's continue drawing. Right here, we just have one move up, no valid retracement candles. Right here, we can see candle 1, candle 2, both being bearish, both being back to back, trading lower than each other. This is a valid retracement, and then we're coming up, touching that high again with 2 consecutive bullish closing candles trading higher than each other. And then the moment we touch this high again, right here, the moment we touch this high, right here, there's our market structure high. The moment we touch the high, that is when this becomes our new market structure low. Okay? What followed was a very, very, very aggressive expansion towards the upside. Is this some sort of valid structure on the 3-day time frame? No, because we only have one bearish closing candle in the retracement. And right here we have one, followed by a bullish, followed by a bearish. We need 2 consecutive bearish closing candles trading lower than each other. So what followed was a very aggressive expansion towards the upside. And right here, we can see in the retracement, candle 1, candle 2, back to back, both being bearish. So this meets the requirement. We have the expansion away of, again, 1 candle going up, 2 candle going up, meeting the 6 candle rule. The moment we touch this market structure high right here, this is when it's created, this is when it's touched, that is when we move our market structure low up towards that new low. Let's continue drawing. We're going up. Right here we have a valid retracement of the 2 candles going down. Right here we see 2 candles going up, 1, 2. This meets the moment we touch that high again, right here, high being created, high being touched. That is when this becomes our new market structure low. Keep on drawing, guys. Right here, we see a retracement of 1 candle, 2 candle, back to back, both being bearish and trading lower than each other, and an expansion away of where the first 2 candles already met the requirement. And then the moment this high gets touched right here, high being created, high being touched, that is when this becomes our new market structure low. So, drawing our structure from the Corona bottom all the way to the first top at 65K, this is what your 3-day structure should look like. Okay? Where this should be your most current market structure low at that point in time. Now, let's do the exact same thing, but then when we are trending down, okay? And let's use as our starting point the bull market top right here. Okay? So, from top to bottom, we have our market structure high, and we have a very aggressive expansion towards the downside where we can clearly see multiple bearish closing candles back to back to back trading lower. So it meets the requirement of a minimum of 2. Then we see an expansion away towards the upside, a retracement, where right here I can see one candle, 2 candle, both being back-to-back bullish closing candles trading higher, making this valid structure. And then we're coming lower again with 2 consecutive bearish closing candles. Now, the moment we touch our market structure low right here, the moment we touch it, doesn't have to be a close, just the moment we touch it, right? The moment we touch it, this becomes our new market structure high. So also when drawing our structure, I identify the low, I wait for the low to be touched again, and that's when I know that that's the highest point that price is traded, in between my low being created and my low being touched. Again, right here, I can see that we have 2 consecutive bullish closing candles immediately on the pullback. So this is already valid structure. I just wait, when does this low get touched right here? This is the highest point that price has traded until my low got touched. In the expansion away, we also have the 2 candle rule. So right here, the moment that low gets touched, that's when our market structure high moves down to that high. Now, is this a valid retracement, guys? No. This is not a valid retracement. Why? Well, right here we can see that we have 2 consecutive bullish closing candles, but the second candle, its highs and its lows, is in between the first candle's highs and lows, making candle 2 an inside bar candle. And that is when it doesn't count. Okay, that is when it doesn't count. So this is not a valid structure. So if it's not a valid structure, what do? We just extend our low until we do have valid structure. Okay. Right here, we can see 2 consecutive candles going up. When does this low get touched? Right here. This is the highest point that price has traded, in between my low being created and my low being touched right here. And then the moment that low gets touched, that's when this market structure high changes to that market structure high. So drawing your 3-day structure on the 3-day time frame from bull market top to bear market bottom, this is what your structure should look like, and that should be your most current market structure high. That is the most important to watch for any potential breakout structures. And it's crucial that you guys understand how to draw your structure properly, and also when something becomes your market structure high and when something becomes your market structure low. Otherwise, you're going to get trapped into any fake breakout structures, okay? Which is a perfect transition into what actually is a breakout structure. Now, a breakout structure is simply when price has a closing price above our market structure high. So this follows the 6 candle rule. Right here we have our market structure high. And the moment we have a closing price above that market structure high, that's when you can call this a breakout structure. And when price is trending up, like we can see right here, and we are breaking my market structure high, expectational order flow will be a higher low for a higher high. And expectational order flow is a very fancy way of saying, what do you think price will do next? So when we're trending up and we're breaking structure towards the upside, we can expect higher lows and higher highs to continue itself. Okay. However, when we're trending up and we break our market structure low, so when we're trending up but we break our market structure low right here, and we have a closing price below our market structure low, we have a bearish breakout structure. And this indicates a shift in trend. So right here we had higher highs and higher lows, but all of a sudden we have a lower low. And now expectational order flow becomes a lower high for a lower low. Okay. So when we're trending up and we're breaking our high, expectational order flow is a higher low for a higher high. When we're trending up and we're breaking our low, expectational order flow becomes a lower high for a lower low. Now, when prices are trending down and we're breaking our market structure low, and we have a closing price below our market structure low indicating a breakout structure, expectational order flow is a lower high for a lower low. And when we're trending down, but instead of breaking our low, we're breaking our high right here. So instead of lower lows and lower highs, all of a sudden we have a higher high. Now expectational order flow becomes a higher low for a higher high. Okay, which again indicates a shift in trend. So right here we have break of structure that are just continuing the trend. And then the moment we all of a sudden have that break of structure at the highs, creating a higher high, that indicates a shift in trend. Now, let's draw this, okay? Let's draw this on the same structure pool I just showed you guys. So I'm not going to explain that structure pool, but I'm just going to draw it, and we're going to have a look at the break of structures, okay? So right here, drawing our structure from bottom, we had a high, we had a low, and we had a higher high right here. And right here, we can see the moment we have a closing price above our market structure high, we can call this a break of structure. And what is expectational order flow? A higher low for a higher high, because we're trending up and we're breaking our high. Right here, again, closing price above it, that's what you can call this a break of structure. Expectational order flow is a higher low for a higher high, especially when you have an aggressive expansion like this. Right here, we had higher low, higher high. Break of structure, we're trending up, we're breaking our high right here. Expectational order flow, again, is a higher low for a higher high. Right here, we're breaking our high. Expectational order flow is higher low for a higher high. And right here, all of a sudden, we get that shift. So instead of having a higher low for a higher high here, we are breaking our low. And we have a bearish break of structure, indicating that shift in trend. Where right now, instead of the higher lows and the higher highs we had prior, we can expect after the bearish break of structure a shift in trend and therefore a lower high for a lower low. Let's make that black. Okay. And then again, after that, we failed to break our low, and this was a wick. You can ignore that for now. It's something we're going to get into later. But what followed after the wick was again a shift in trend, where instead of the lower highs and the lower lows, we actually closed above our high right here, making this a bullish break of structure. So we were trending down, we broke above our market structure high, so now we can expect a higher low again for a higher high. Now, was this valid structure? Little tricky question. Was this valid structure? No. We have one bearish candle, we have one inside bar candle, and then we have one bearish candle here. That's not valid structure. It may look like structure on a lower time frame, but not on this time frame. Okay? So right until here, we got that bullish break. Expectation order flows higher low, higher high, which we got. And then right here again, all of a sudden, we have that shift in trend. So from this low, we had a higher low and a higher high. But instead of putting in another higher low and a higher high, we had a lower low, okay? Indicating a shift in trend. So what can we expect after shifting our uptrend? Well, now, instead of higher lows and higher highs, we can expect a lower high for a lower low. The moment we have a closing price above it, right here it's a wick. That's not a closing price. Right here on this candle, we have the closing price above it. That's when we can call this a break of structure. Expectational order flow is a lower high for a lower low. And then right here, the moment you have a closing price below your market structure low, that's when you can call this a break of structure. And right here, we had again a lower high for a lower low. And then the moment we closed below it here, you can call this a break of structure. So see how you could have literally traded the entire previous cycle by just understanding market structure. Because if you understood this uptrend and the fact that this uptrend changed right here in April 2021, you could have sold your positions. And right here, when you broke back the bullish, you could have bought your positions back. And the moment you broke back the bearish, you could have sold your positions again. So just by understanding structure and you apply it on the high time frame, you could have sold right here, bought back right there, and sold right there. 3 trades and you absolutely nailed the previous cycle. See how crazy effective this is, guys? By just understanding the structure and applying the 6 candle rule and when something becomes your market structure low, and then what you can expect after a bearish break in an uptrend and a bullish break in a downtrend. It's so effective, guys. It's so effective, okay? So practice this for yourself. Practice drawing your structure, applying the 6 candle rule, knowing when something becomes your market structure low or your market structure high, seeing those shift in trends and what follows afterwards. And this applies on all time frames. I'm just showing you right now on the high time frame, okay? Now, there is a difference between a good break of structure and a bad break of structure. Okay, so in order to have a good break of structure, you want your break to have some good distance away from your market structure high. So we can see right here, this is our market structure high. And right here, we can see 2 aggressive expansion candles breaking structure where they have a good distance away from our market structure high. The other requirement is that we have a minimum of 1 candle spent above our market structure high prior to retracing. And the candle that caused the break does not count. So we can see right here that we're breaking structure on this candle. And then we have 1 candle right here. And then 2 candles prior to coming back below our market structure high right here. So we have a good distance away and we spent 1 candles and 2 candles above it prior to retracing, indicating that this is a good break of structure. Right here, okay, we can see that we have no good distance away from our market structure high if you compare it to the previous picture I just showed you guys. And we have no minimum of 1 candle spent above our market structure high prior to retracing because the second candle immediately closes below our market structure high, okay? So a good break has a good distance away from a market structure high and multiple candle closes above it with a minimum of 1. A bad break of structure has a candle close above it and the second candle immediately closes back below with no good distance away. And whenever you have a bad break of structure, I would be very careful with calling for a higher low for a higher high when you're trending up because the break is not that convincing. When you have a good break, it's very easy to call for a higher low for a higher high. Okay, when you have a bad break, you need to be a bit more careful with calling that order flow objective. And you can also see that in the chart, right? So right here, when we were drawing our structure, this right here is a very convincing break of structure. Okay? This right here, we can clearly see that we have multiple candle closes above it prior to retracing, and we never even retrace below our market structure low. So it's a very aggressive expansion towards the upside. And we can see that change right here. So when we keep on drawing, we can see that this was a break of structure, but we can see that the second candle, okay, immediately closes back below. It immediately closes back below. So this is a very sketchy and not good break of structure. So I would be very careful with calling for a higher low for a higher high. Yes, it did happen this time, and later in the video we're going to talk about how you can know if it's going to happen or not. But I would be very careful, okay? Because look what happened afterwards. Right here we got back-to-back break of structures where there were no good break of structures, because also here we have 1 candle close above it and the second candle immediately closed back below with no good distance away. And what can you see? Well, right here is where the shift in trend occurred, where you didn't have that higher low for the higher high, but you had that lower low. Okay, so this is a very good breaker structure, and with much conviction can you say, okay, we can expect a higher low for a higher high. But then the moments you don't have it, you be very careful, because you can see that sooner rather than later, you're going to have that shift in trend. Breaker structure, guys, absolutely key in our game of trading. Now, besides a breaker structure, we could also have a wick. And what is a wick? A wick is when price takes your market structure high or low, but it fails to have a closing price above or below it. Okay, so we can see right here that price is trending up. Obviously, the 6 candle rule applies. We touch the high, so this becomes our market structure low, but we do not have a closing price above our market structure high right here. No, we exceed it, but we close below it, causing us to wick the high. And some other people like to call it a swing failure pattern, an SFP. Okay? Now, an SFP makes the other low weak in nature. What do I mean with weak? Well, the job of the low in an uptrend is to take out the high and to close above the high. When we wicked, we fell to close above our market structure high, and we could have a rotation back down towards our market structure low. And it's the other way around when we're trending down. So when we're trending down and we fail to have a closing price below our market structure low, the high can become weak, and we could have a full rotation back up towards that market structure high. But in this example, back down towards our market structure low. So after a wick, there are 3 scenarios that can appear. Okay, there are 3 scenarios that can happen. We could have a full rotation back down, like you can see in scenario 1. Okay, so we're trending up, we're wicking the high, and we could have a full rotation back down towards our market structure low. In scenario 2, we can see that we are wicking the high, we're getting a reaction away from it, but we do not come for a market structure low, and we do put in a higher low for a higher high. And in those scenarios where we do get the reaction away from it, that is when our new market structure high to break becomes our wick high. Okay? So when you get that reaction away from it, we just change our new breakup structure level to the wick high. So the wick high becomes our market structure high. Okay? And we just continue drawing our structure like this. But we cannot call it a breakup structure until we close above our wick high. And the third scenario is just when we wick our market structure high right here, but then the second candle immediately closes above it. And that is when you still have a breakup structure. So we wick our high. Scenario 1, we could have a full rotation back down towards our market structure low. Scenario 2, we get a reaction away from it, but we do not come for the low, and we still put in a higher low for a higher high, but we can only call it a breakup structure when we close above our wick high. Third scenario, the first candle wicks, but the second candle immediately closes above it, and then we still have a breakup structure. And we can actually apply this to the chart, and a very key example was right here, okay? From our bear market low right here, we were trending up, okay? We were having higher lows and higher highs, okay? And right here we had a higher low for a higher high. But what we can see is instead of closing above our high like we did right here, it's actually 2 perfect scenarios back to back. So right here in our first market structure drawing, okay, we wicked the high, but the candle after, we immediately closed above it. So in this scenario, we can still call it a breakout structure. Okay? But in the second market structure pool, we wicked our high, and look what happened. Price came back down for our market structure low. But then look what happened. We wicked our market structure low. So now price could have a full rotation back up towards our market structure high, right? And this becomes our new breakout structure high. And right here we have a closing price above it. So while other people may call this like a downtrend where, you know, it's a lower low, yes, it is a lower low, technically speaking, but it's a wick. So you can see it right here. We wick the high, and the low becomes weak, and we can have a full rotation back down towards our market structure low. And then when we have the full rotation back down, we wick the low, and now the high becomes weak, and we can have a full rotation back up towards our market structure high. Okay, so when we have a wick, it's not a breakout structure, and they're two very different things. And it's very important to understand, because a lot of people misuse wicks, okay, and they're calling it market structure breaks. It's not, okay. A wick is actually making the other market structure point weak in nature, okay. Now, to determine which ones of the scenarios is going to take place regarding the wicks, we have to understand different levels of market structure. We have different levels of market structure, and this is the most important part of this tutorial to understand, okay? And it's also more advanced, but once you understand this, you'll become a master in already predicting where the market is flowing, okay? Depending on the time frame that you are on, you will have different levels of market structure, okay? And it is important to understand that the higher the time frame the structure, the more important and significant it has. So, let's say we have a high time frame uptrend, okay? Let's say we have a high time frame uptrend, and we have a higher low and a higher high. And we can say that our black market structure drawing represents our daily time frame, okay? So this is our daily time frame, where right here we have those pivot points of a low and a high, and a higher low and a higher high. And this also follows the 6 candle rule, obviously. So we have a daily uptrend, guys. Well, I told you that prices do not go up in a straight vertical line. And in order to get from point A to point B to point C to point D, you need to move up, down, and up. But prices do not move up in a straight vertical line. And we're on the daily time frame right now. So what you will see when you go down to the 4-hour, you'll see actually some sort of an uptrend inside of your daily time frame, which will look probably something like this. And we can make that red, okay? Because in order to get from point A to point B, prices need to go up. And maybe on the daily time frame, it will look like just one move up, but on the 4-hour time frame, okay, you'll actually have some zigzag patterns, aka market structure. So your 4-hour time frame has some structure inside of your daily structure, okay? Overlapping structure. But we can dissect it down even more. So if we're just looking at the pivot points right here on the 4-hour, we know in order to get from point B to point C, prices need to go down, okay? On the daily time frame, that may seem like one move down. If we zoom in on the 4-hour, we can actually see some sort of structure. But we could also zoom in on the 30-minute. And on the 30-minute, you may actually see some structure inside of your 4-hour structure, looking like something like this. Let's make that blue. Because in order to go down right here, to have this 4-hour, I'm looking at my red marker structure drawing right now. In order to go down on the 4-hour, it may seem like one move down on the 4-hour, but on the 30 minutes, you may actually have some structure that you can look for. And I always boil it down to 3 structures, okay? Where our black, okay? Black is our high time frame structure. Red is our mid time frame structure, and blue is our low time frame structure. Okay? And it's very crucial that you guys understand that the higher the time frame the structure is, the more importance and significance it has. Okay? However, the high time frame is the most important. But the low time frame breaks start the high time frame pivot points. And using and paying attention to all of them allows you to never get trapped. So, how we can use this overlapping structure to our advantage? Well, let's say prices are trending up on the high time frame. Let's make that black. Black is our high time frame, okay? So let's say prices are trending up on our high time frame. We have that breaker structure, and we're actually coming into an area of significance, okay? Because right here, we have a support zone. We have some demand. Now, we know that our black, in this case, represents, for example, our daily time frame, okay? If we zoom in on the 4-hour, we may actually see some structure inside of this daily downtrend, local downtrend, okay? Because we're trending up on the daily, but from top to bottom, we may actually see some 4-hour structure. And when we zoom in, looking at this last expansion towards the downside on our 4-hour time frame, we may actually have some 30-minute structure like this. Let's make that blue. Okay. So right here is our blue market structure high. Right here is our red market structure high. And right here is our black market structure high. And how we can use this knowledge to our advantage is something I call the domino effect. Okay? It's something I call the domino effect. And what the domino effect means is that the moment we break our blue market structure drawing back to bullish, that could mean a rotation towards our red market structure high. And when we break our red market structure high back to bullish, that could confirm a rotation towards our black market structure drawing high. The domino effect. You break blue, you move up to red. You break red, you move up to black. And now, when we break our blue market structure drawing back to bullish, and we can expect a higher low for a higher high to our red, we can already expect, not confirm, but expect that this could be our pivot point and our market structure low on this massive high time frame move. Just like this. By watching our 30-minute structure, we could potentially already confirm this uptrend that's going to continue itself. which is absolutely crucial because you can already find local entries having a good bias. Okay, so it's crucial that you keep this in mind. Black is the most important, and that's your high time frame. Red is your second most important, that's your mid time frame. And blue is your least important, your low time frame. But in order to get a pivot point on your high time frame, you need the low time frame breaks. That is what I was just referring to. That the high time frame is the most important, but the low time frame breaks start the high time frame pivot points. Because let's say this did happen, where our black market structure drawing continued itself. Okay? Well, then blue and red must have broken back to bullish. But we can already determine and expect a potential high time frame pivot the moment we break that low time frame downtrend from top to bottom. Okay? And not only does it allow us to expect potential pivot points already on the high time frame by looking at the low time frame breaks, it also allows us to stay out of potential fake breakout structures. Okay? Let me elaborate. We're coming into that area of support. Okay? We know that if we break our red market structure drawing, okay, we know that if we break our red market structure drawing back to bullish, that can confirm our expectation of having that high time frame pivot and that high time frame higher low for the higher high using our black market structure drawing. So what that allows us to do is we can just wait for our red to break back to bullish, okay, and then long the retracement up towards our black high. But what happens, okay, what happens if your red never breaks back to bullish? If your red never breaks back to bullish and you just continue downtrending and you take the low, well, you would have never even longed the higher low because you were waiting for your structure from top to bottom on the lower time frame to break back to bullish. And if that doesn't break back to bullish, you're never going to get your pivot point on the high time frame. So knowing these overlapping structure rules, you will never get trapped, okay? You will never get trapped into longing a higher low because you can wait for the confirmation from the low time frame structure from top to bottom. And if that doesn't break the bullish, you don't long the higher low. Okay? You don't long the higher low. Because sometimes it happens that you have a fake break when your break of structure is not good, like we just discussed earlier in the mentorship. Bad break of structures. No good candle closes above, no good distance away. Well, if you don't have a good break of structure and you see a downtrend on the lower time frame and that doesn't break back to bullish, you never long the higher low. So let's apply this knowledge now, the domino effect, and the way you can stay out of trades to the charts. Okay? Let me have a sip of my water, guys, because I'm getting excited here, you know. This information is so good. Okay? You'll be the best swing trader that is out there by just understanding these market structure rules. Okay, let's apply it to the chart, guys. Let's apply it to the chart. So, I'm going to use that same structure drawing, okay? I'm going to use that same structure drawing. I'm going to skip over these first few points, okay? Right here. We had that higher low and that higher high, okay? Well, let's look at these pivot points on the high time frame. Let's make this black because we were just referring to black as our high time frame. These are our pivot points. Let's get rid of this drawing and let's zoom in. Let's zoom in. I'm on the 3-day time frame, right? On the 3-day time frame, this looks like one move down. I cannot draw structure using the 6-candle rule inside of this downtrend. But if I go on the 8-hour, look at that. We can actually see some structure on the 8 hour. So on the 8 hour, we have a high, we have a low, and we have a lower high, and we have a lower low. You see that? We have structure on the 8 hour that wasn't structure on the 3-day. So let's put these pivot points on the chart. Let's make it red. Now, let's check this last expansion towards the downside for even more structure. Okay, let's go on, for example, the 4 hour. I already see some structure on the 8 hour as well in this downtrend. That is also possible. Let's go on, let's say the 4 hour. You can kind of switch through time frames to see on which time frames the market structure rules apply. Oftentimes the 4 and the 6 and the 8, it could be the same. Okay, it could be the same. But what we see on the 4 is we see a move down, we see a move up, and we see a move down. So these are our low time frame pivot points. And you determine your low time frame depending on what you pick as your high time frame. Okay? So our high time frame is in this case the 3-day. Then our mid time frame might be the 8 hour, and our low time frame might be the 4 hour. But if you pick your black market structure drawing as your 1 hour, your mid time frame might be the 15-minute, and your low time frame might be the 3. Okay, it just depends on where you're looking at. But I always boil down to just these 3 market structure pools. So what do we know? Okay, what do we know? If we break our blue market structure high, okay, that can confirm a rotation towards our red market structure high. And if we break our red market structure high, that can confirm the rotation towards our black market structure high. Well, we wicked it here first, okay? We wicked it here first, which is something I'm going to get into later, what you can do when it wicks it, okay? But if we just extended, so we got the wick, we got the reaction from it, right? We got the wick, we got the reaction. We got another wick, we got the reaction. So in those cases where we get those reactions, like we were just talking about, that's when we extend our break of structure. But right here, we got that break of structure. So right here, we got the break. That confirmed the rotation towards our red. On the red, we got the break, and that confirmed the rotation towards the black. You see how that works? You break blue, you go to red. You break red, you go to black. Okay, let's keep on drawing. Not only that, guys, not only that, the fact that we broke blue confirmed that it could be a potential pivot point on our black market structure drawing, which was the 3-day, right? If we never broke that back to bullish, this would have never been a low. And you would have never gotten trapped into thinking that this was going to be a low. So let's continue drawing. Let's exit replay mode. Go back to the 3-day. Right here. This was our next. So we had our high, higher low, boom. Let's make it black. Right here we had our right here we had that second pool, okay, with our bad break of structure. Okay, we had that bad break of structure here. But let's see. Let's see. This was our high on the 3-day. This was our low. Was there a way to confirm this potential pivot point using lower time frame structure? Let's go into replay mode, and let's boil it down to 8-hour structure or 6-hour structure. Okay, let's do 6. These were our pivot points. If I zoom in, we can actually see some structure inside of our 3-day structure. That goes like this, obviously applying the 6 candle rule. And this is our 6-hour market structure high. Let's put the pivot points on the chart. Low, high, lower high, or low, low, lower high, lower low. Let's get rid of it. Now, let's check if we have even more structure in this last expansion towards the downside on the 6-hour time frame, and let's go on the 1 hour. On the 1 hour, we see structure inside of that 6-hour structure. That is lower high, lower low, lower high, lower low, lower high, lower low. Blue. Let's make it our pivot points. Where this is your blue market structure high. So guys, what can we say using the domino effect? Well, the moment we break our blue market structure drawing high, we could come up to our red market structure drawing high. And the moment we break our red market structure drawing high, right here, we could have a rotation to our black market structure drawing high. And you see how this played out literally to perfection? And how you could have potentially already confirmed a high time frame pivot point on this break alone? Knowing that if you break this high right here, you could have a rotation towards your red high. And the moment you break your red high, you can have a rotation towards your black high. And therefore, you know, in this entire bit of price action, you could have looked for longs and take it towards that black market structure high, because that is your order flow objective on the high time frame. See how you can build amazing context now? How you can know by breaking these market structure points, you can look for longs in this entire bit of price action and take it towards that red market structure drawing or black market structure drawing high, because your bias is correct. Okay, your bias is correct. And you not only know that you're going to get that high time frame pivot point and the higher low for the higher high. If this didn't happen, if you didn't break your blue, if you didn't break your red back to bullish, you would have never longed it. And you would have never gotten trapped into longing a potential higher low for a higher high on the high time frame, because you never broke your mid and your low time frame back to bullish. So it gives you an amazing way of knowing where price is heading to next, while also keeping you out of trades if it doesn't happen properly. Because let's continue drawing, guys. Let's continue drawing right here. I want to show you one more. We just continue drawing. We had our structure, we had our high, we had our higher low, our higher high, our higher low, our higher high. Let's keep it black. This is our 3-day. Right here, we have a bad break, okay? Right here, we have a bad break. This was that first bad break of structure I was talking about. So we should be very careful with longing a potential higher low, okay? We should be very careful with longing a potential higher low. Let's zoom in. Let's see if there's structure inside of this downtrend on the 3-day. Let's go on the 6-hour. There we go. These are our pivot points. That 3-day low, that 3-day high. Let's draw our structure right here on the 6-hour. Let's make that our red market structure drawing. Putting the pivot points in again. Red, red, lower low, lower high, lower low. This being your red market structure drawing high. And then let's zoom in to see if we have structure inside of this last expansion towards the downside on the 6-hour to see if we have even lower time frame structure. Let's go on the 1 hour, okay? And you can just flicker through the time frames to see what price gives you. Maybe it's 1 hour structure. Maybe the 1 and the 2 hour is the same. We can see right here on the 1 hour, we have a low, lower high, and a lower low. Putting the pivot points in. There you go. Let's apply the same effect. The domino effect, okay? If we break our blue market structure drawing high, that can confirm a rotation towards our red market structure drawing high. And if we break our red market structure drawing high, that can confirm the rotation towards our black market structure drawing high. If we never break blue and if we never break red back to bullish, you will never get a higher low because we were very careful with longing a higher low because we had a bad break of structure. But you can see right here that you break your blue back to bullish and you get the rotation to red, and you break your red back to bullish and you get your rotation to black, confirming that this could potentially be that higher low and that this can be that high time frame pivot point, and we're going to come back to that high even though the break of structure was not that good. Even though the break of structure was not that good. Okay? So it gives us that reconfirmation, that reassurance of like, okay, we did have a break of structure, but the break of structure was not the best. Okay? So we just wait to see if we can get a reconfirmation, and we can wait for our mid time frame and low time frame structure, to give us any signs of strength by breaking back the bullish, confirming those rotations up. Again, giving you a bias that, in this entire bit of price action, you could have looked for longs to take towards that black market structure drawing high. Now, let's look at that last expansion, okay? Let's look at that last expansion because you can see the difference with what I mean with the reassurance that you can get. Because right here, we had yet again a bad break of structure, okay? And what followed was not a higher low for a higher high, but what followed was a lower low, okay? What followed was a lower low right here. Well, knowing the domino effect, and knowing that we can just wait for a break of structure on the lower time frame to break back to bullish to confirm the rotation to the mid time frame, and the mid time frame to break back to bullish to confirm the rotation to the high time frame, in that flow formation. If that doesn't happen, we're never going to long any form of a higher low. Okay? And if we check, guys, between our high and our low on the 3-day, let's see if we would have gotten trapped. Let's go on the 6-hour time frame. We can do the 4 to have a bit more structure. There you go. Well, you can clearly see that your mid time frame structure had a lower high and a lower low and a lower high and a lower low. Putting the pivot points in the chart. Right? These are our pivot points. We can dissect it even down. Let's check if we have structure instead of this expansion towards the downside on, let's say, the 1 hour. Yes. On the 1 hour, we have a high, lower high, lower low. Let's make that blue. Right here, put the pivot points in the chart. Look at that. Do you see how your mid time frame was trending down and your low time frame was trending down, and you never confirmed any break back to bullish? You never broke your market structure high, confirming a rotation to your mid time frame market structure high, confirming a rotation towards your black market structure high. You never broke that high. So you would have never gotten trapped into thinking it was going to be a higher low. Because you can wait for your structure from top to bottom to break back to bullish. It works so good, guys. It works so good. And it works the exact same in the downtrend. I showed you the drawing example. I showed you the drawing example while uptrending, actually, but it works the exact same way in a downtrend, confirming a lower high for a lower low. Okay? But do you see, let's exit replay mode. Do you see, guys, how how these markets flow, how the way of looking at the chart using proper market structure and proper breaks and the domino effect and the reconfirmations, that it moves in this swarm of structure where you move up and you move down and your mid and low time frame are trending down and your low time frame breaks back to bullish, confirming a potential pivot point on the high time frame. And it moves in this swarm where if you understand it, you can always be on the right side of the market from a high time frame context perspective. And right now I'm showing you guys on the high time frame. I'm showing you on the daily, the 4 hour, and the 1 hour. It works the exact same way locally. When your black markers are drawing, so your high time frame might be representing the 30-minute, and then you have the 10-minute, and you have the 3-minute. Works the exact same way. But it's so effective. Like you can see it. I'm showing it you guys right here. I'm showing it you. It's so effective. So really, really take your time practicing this. Because once you have mastered this, everything else will become so much easier. So much easier. So much easier. Okay. Now, let's come back to that wick situation, okay? And how you can determine, based on understanding that domino effect now, how you can determine which scenario is most likely to happen for the wicks, okay? So, when we're going up, actually, let's grab that drawing. Practice this, guys. Practice drawing this, okay? Truly practice it. I'm going to get rid of it. So, coming back to that wick situation. In situation 1, to have a full rotation down, you have to have, in order to have a full rotation down, you have to wick the high, and most likely you have structure from the low up that breaks back to bearish. Okay? Our mid time frame structure. So when you wick the high and you break your mid time frame structure, so your structure from the low up back to bearish, that's when you're going to have that full rotation down towards your market structure low. When that doesn't happen, okay, and this is your mid time frame low, and you never break that mid time frame low, and you go on the low time frame and you see that structure from the top down breaking back to bullish, that's when you confirm situation 2. And situation 3 speaks for itself. Okay? Situation 3 speaks for itself. So when you wick the high and you break your mid to low time frame structure from bottom to top, you'll most likely get that rotation towards your market structure low. When you do not break your structure from bottom to top, and you actually break your structure from top to bottom back to bullish, that's when the structure will probably continue itself, because that's what we have literally just been doing this entire time, where you have your high, low, higher low, and this higher low is going to get confirmed when you break structure from top to bottom on the lower time frame. That's literally what we just did the entire time with the domino effect. And in this scenario, your structure from the top down will probably not break back to bullish, okay? Will not break back to bullish. So that, with the understanding overlapping structure now, that's how you can determine which one of these scenarios is going to play out. So let's look at it actually from the example I was showing you guys right here, where we were wicking the high. I'm drawing the range. I'm exposing already some secrets of ranges. Ranges is something we're going to get into next, guys. Next tutorial. But right here, you have a wick of the high, SFP, and then you wick the low. So in these situations, you had a full rotation back down, and back up. Let's see if we can apply that structure I just gave you as a little trick. Right here, let's go on the low time frame. As you can see, while drawing your structure from the low up, we have a low, we have a high, for higher low, higher high, higher low. Did it wick it? Yeah. All the way up to here. And then we broke it. So we broke our structure. First we wicked it. Okay, first we wicked it. There we broke it. So on the high time frame right here, the moment we broke it right here, that confirmed the rotation back down towards that market structure low. Okay, and the other one was a bit more sketchy because you didn't really have that much structure. You didn't have that much structure because right here we wicked the low, but our structure from top to bottom, was looking like this, where this is our market structure high, and we wicked it right there, and then we closed above it afterwards because we got the reaction away, so this becomes our new breakup structure. But that was already very close to this high. But this was just such an aggressive expansion. Maybe it's low time frame structure on the 1 hour. Nah, it was just such a big wick. It was such a massive move down. This was trickier to trade, and we'll get into how you can trade those situations in later videos in this mentorship. But you can see, you know, that the moment we break our structure from the low up after wicking the high, we can have that full rotation down. And let's say this was structure, you know, let's say this was some sort of structure right here. That will mean that the moment you break, it's very ugly drawn. Okay. That will mean that the moment you break this high right here, the moment you break that high, that will confirm that rotation back up towards your new wick high. So guys, let's delete all of this. So guys, it's the PC is also starting to lag. the tutorial was too good. Lecture 1 was too good. I understand, just listen to my voice. I understand that the information could be a bit overwhelming. Okay, I understand that the information can be overwhelming, but really boil it down to first drawing your structure using the 6-candle rule. Okay, then applying your market structure lows and your highs in the correct way, identifying breakup structures, and you know when you can expect a continuation or a reversal of in the trend, and then try to overlap your structure into high time frame, mid time frame, and low time frame, and you'll see how those low time frame breaks oftentimes create the pivot points for the high time frame. Because the low time frame makes the high time frame, but the high time frame is still the most important. Because what you do have to watch out for, is when you break your low time frame back to bullish, okay? Just imagine the domino effect. When you break your low time frame back to bullish, but prior to your low time frame breaking your mid time frame, you break that same low time frame back to bearish again. Okay, so just imagine the domino effect I was showing you guys and the blue market structure breaking back to bullish. If that blue market structure drawing breaks back to bearish prior to breaking your red back to bullish, that is when you have to watch out, because that's when price can be heading lower again. My PC is getting a bit laggy. Literally, the mentorship was too good. Lecture 1 was too good. But it's only going to get easier from here as well, okay, once you understand structure. But you saw how literally you could have known how to trade the entire previous cycle by just understanding structure alone. And when you also understand ranges and you also understand Wyckoff, it's going to get absolutely insane. Okay, and TCT schematics to combine it, supply and demand, and liquidity. We're going to get into all of it. So go and practice this. Okay, go and practice it. Just play around, try and draw it, and then continue watching lecture 2 of this TCT mentorship. And guys, thank you for trusting me as your teacher. And there's no one out there that can teach better than me. Okay, I don't care who you know, but purely from a teaching perspective, there are many other good traders, but there are not that many good teachers. Okay, I am going to make you profitable. I'm going to make you profitable. Just trust me. Okay, if you put in the work with the information I'm giving you guys, it's going to work out. I love all of you, and I'll see you in lecture 2, where we'll be going to talk about ranges. Peace out, guys.